Hello, this is Tim Dial with Nexa Mortgage, and just wanted to talk a little bit about what's currently going on in the market and the how credit scores can impact your ability to buy a house, how to improve your credit scores, and some of the things that are going on right now that are going to impact uh, those issues. For instance, right now, the CFPB through the current administration, the CFPB has sort of been ruled to start working toward eliminating medical collections from credit reports. Well, this is going to have a huge impact on a whole bunch of Americans. If your credit score is currently below 600 and you have medical collections on there, especially newer medical collections, if they remove those, it's going to definitely raise your scores up. So um, right now, I know the CFPB is trying to get the bureaus to start taking steps to remove some things, and I think the smaller medical collections are automatically being removed now. But by early 2025, it's my understanding that the CFPB is going to rule that all of the medical collections will be removed. So, and this is something that I don't like to get into whole political arguments and things like that. I'm an independent and I don't really like politics, but the current administration has sort of been working with the CFPB to try and make these things happen, to make credit more available for Americans, and therefore to make buying a home more possible in the future. Credit scores not only impact your ability to buy a house, but it also impacts the interest rate you will get when you go to buy a house. So if they can improve credit scores throughout the United States, one thing that they've figured out is that if somebody does have medical collections, the uh, the medical collections or people who can't pay those medical collections doesn't really show accurately whether or not they pay their regular bills. And so that's why they're trying to take these steps to go and remove medical collections. If you're not paying your credit card bill and that's going into collections, or if you're not paying a car payment and that's going into collections or something like that, those things truly show that somebody's not willing to pay, and that should really hurt your credit score as a result. But it's certainly a lot different when it comes to medical collections. You know, if you go and you have some sort of serious procedure, you don't have insurance, you get $20,000 on your that you owe the hospital or something, and there's no way you can pay it. Well, that's different than something else you incurred that was your own choice, you know. So anyway, that's a big step that's going on right now. Is you might see medical collections starting to drop off your credit reports, and as a result, you might see your credit score going up. So in the meantime, there are other things you can do and other steps you can take to also try and improve your credit scores. And I want to get into that a little bit. One thing that people don't understand a whole lot about is um, how credit utilization impacts your credit. It's the biggest item other than trying to get collections off your credit, things like that. The next biggest thing that impacts your credit is what they call credit utilization percentage. And it's based on primarily revolving accounts or credit cards. So just to give you an example, let's say you have a credit card with $1,000 credit limit and you owe $900 on that credit card. They'll say you're utilizing 90% of the credit available to you on that card. That looks bad. It looks like you're maxing out the card. You don't have hardly anything left on it. And as a result, that hurts your credit score. You take that same account, get it paid down to $200. You still have 1,000 available, but you only owe $200. They'll say you're utilizing 20% of the credit available on that card. That looks really good. It looks like you are keeping your utilization percentage down. You still have all this money available to spend that you're not spending, and you're managing your money well, is the way it looks to them. So as a result, when that happens, your credit score goes up once you get that paid down, and that's kind of how that works. And then they look at kind of a cumulative effect. So if you can keep the percentage down for multiple months, it helps you more than if you go from having a high percentage to a low percentage back to a high percentage. You know, if it's fluctuating a lot, that's not going to help you as much as if you keep it down for multiple months, if that makes sense. So that's a little bit how that works. One thing you can do too is If you do have, let's say you have $30,000 worth of credit cards and you have these high utilization percentages, if you can obtain a personal loan, and let's say you obtain a personal loan for 30,000, you pay those credit cards off, and now you just have this one personal loan for 30,000 that you're paying on monthly. Then you see your credit score really jump because that personal loan doesn't go into the utilization percentage. It's considered as an installment loan, not as a revolving account. And so that's something that can really help your credit, is if you can move it from revolving to installment. Now it's critical if you do that, if you do get the 30,000 and you get those credit cards paid off, then you don't want to start putting a bunch of money on the credit cards again and getting that, percentage back up again, because now you have this installment loan you have to pay on every month, and now your credit cards are going up again. So it's just really critical not to have that happen, if that makes sense. So anyway, that's a little bit about that. Now the other thing that I wanted to kind of go over and cover is the way student loans are impacting things right now. The current administration has passed some student loan debt forgiveness and things like that, and there's a lot of confusion over how it works and what it means and things like that. So, some people, and this a lot of this is all political, and I don't like to get into that, like I said, but there are a lot of people claiming, well, they're forgiving all the student loan debt that people owe, and it's just not right, blah blah blah, and that's just not true. What they're really doing is they're trying to forgive what is essentially interest on these student loans. And so just to give you an example, if somebody took out a student loan for $40,000, and then over 10 to 20 years, they've been trying to pay it back here and there, and they've actually paid back the $40,000, but during that period of time, it accrued a bunch of interest and they still owe $20,000 because of the interest. Well, what the federal government's doing, there's like, well, if you've paid back the 40,000 and the rest of what you owe is just interest, we're forgiving it all. We're forgiving all that interest because you've paid back the principal at this point. And so they're trying to get people out of the student loan debt like that. Additionally, they've created some new rules so you don't have to pay on these things forever. If you go on like they have new rules for like income driven repayment plans, IDRs they're called, and they have another one called SAVE, SAVE. And it's my understanding under those plans, they have provisions for, once you've paid for a certain period of time, they will forgive the rest or something like that. So it's very important to get on those plans, and that way you can take advantage of some of these things. The sooner you get on them, the sooner you get to that point, to that number of years where they might get forgiven. So that's important. And then the other thing too, a lot of people don't realize is if you have student loans that are currently in default or something like that, then you want to get those reinstated as soon as possible. And they've made it much easier to get things reinstated. Used to, you had to make payments for like 10 months or something like that to get them reinstated. Now, it's my understanding, if you call and get it set up, they'll reinstate them, very quickly. And then as soon as you get them reinstated, you can go on one of these plans, either SAVE or IDR, start making payments based on that. And it's because it's based on your income. If you don't make a lot of money, then your payment can be very low, sometimes even zero. So very important to get reinstated as soon as possible. And that's for two reasons. For one, you can take advantage of these new programs and possibly getting it forgiven in the past or in some point in the future. And then the other reason it's important is because once you get it out of default, then it no longer negatively impacts your credit score. Student loans in default impact your credit score a great deal usually because it's looked at very negatively in the market. Usually you cannot file bankruptcy on student loan debt and things like that. So if you have student loans that are in default, that looks really bad to the bureaus and they really hurt your score over that a lot of times. So that's a little bit about how that works. But the other thing too that I wanted to get into briefly is that even though your credit score may not be where you want it to be, there are programs out there that allow us to help people purchase a home when their credit score isn't quite as good. That's especially true if you have assets through, like, let's say you have a 401k account with $20,000 in the bank or something like that. If you have assets, then the underwriter looks at that as reserves. And the more reserves you have, the stronger your situation is. So even if you have a lower credit score, you're more likely to get approved if you have reserves. If you don't have reserves, then it is a little bit tougher, and we need to work harder to get your score up a little bit more. But there are programs available to allow us to do loans. I've got somebody right now who is, below a 620 credit score and does have reserves, and we're able to get an approve eligible recommendation from the lender from the automated underwriting system. And that's very important. It makes the process much easier. We're also getting them a down payment assistance grant, so they're not having to bring the down payment to the closing. The seller's paying $5,000 of their closing costs, so they're only going to have to bring a few $1,000s to closing, and that's to pay some of their closing costs. And so it's a very good situation for them, and that's with a pretty low credit score. So it is possible to get into one. The other thing too that we're doing is helping people get their credit scores up. And the way we do this is, if you think your credit score is low and you're not going to be able to purchase now, we can do something called a soft credit pull instead of a hard credit pull. It still gives us all the same information, the same account information, it gives us all three of the credit scores. And then it also gives us a tool that is called the Credit Expert tool. And through that Credit Expert tool, we can go through and run a simulation as far as, okay, what happens if we do this? What happens if we do that? If we pay this account off, or if we pay this account down, how will that impact the credit score? And then we come up with a report for the customer and says, okay, here are the things you can do to improve your credit score over the next few months. And if you do these things, your credit score is likely to go up by this much. And then you'll be ready to buy a house at that point. So it gives us sort of a I guess you would say, a map of how to improve the credit score and put somebody into a position to be ready to purchase a home if they're not right now. So those are some of the things that we're doing. But I plan on putting together, I wanted to get this video out there first, but I plan on also putting together a blog that I'm going to add to my website either today or tomorrow. And in that blog, it's going to have a lot of the same information that you can just kind of read through when you want to. I do have a blog section on my website. The website's extremelending.com. And so I do add a blog article on there every once in a while when there's something that I think is important that people need to know. So I plan on adding that. If you have any questions or anything, certainly feel free to reach out to me. My office number is listed there above my head. And then I also have a mobile phone, which is 615-995-2615. So feel free to reach out to me. My office number also accepts text, just like my cell phone. So that's pretty much it. If you have any questions, certainly let me know, and I look forward to talking to you later. Thanks.